Welcome, everyone. My guest today is Andrew Batey, an executive who operates at the absolute vanguard of both technological entrepreneurship and institutional capital allocation. As a serial founder, Andrew has successfully scaled five different companies to hundreds of employees, personally raising over $150 million and securing more than 40 international patents across artificial intelligence, machine learning, and blockchain. Today, he is the co-CEO of Beatdapp, a trust and safety infrastructure company protecting the digital economy from systemic fraud, and he is the founder and managing partner of Sidedoor Ventures. Andrew, it is a privilege to have you here. I'm really excited to host this session, and to kick things off, I'd love to hand the floor over to you. Can you explain in your own words your businesses and you know, how you decided to build and how you went on about it?
I guess it was more of an accident. I had some money. I didn't really trust the the stock market when I was in my 20s, so I started investing in kids that were building stuff. Eventually, they needed help. I ended up joining the team as a co-founder, building and scaling the company, and found out I was actually pretty good at tech. I'd always viewed myself more as a marketing, sort of like entertainment guy. So uh, you know, I've spoke a lot about how I used to in the early days hack a lot of stuff. That was kind of like my background. I was really good at sort of the tactics of things. And then just built and sold a couple companies. I feel like my brain's always working and I end up sort of jumping into new things that I'm excited about. If anything, I probably suffer from overconfidence where I am convinced I can do something and I just go. But yeah, built and sold a couple companies. And then I think like a lot of founders, when you sell something, your identity is tied to it and you're not really sure like who you are. You feel a bit of anxiety around like who you are as a person. And so, yeah, I think that's kind of, I just jumped into venture capital kind of by accident. Like people started asking me to invest. I started investing with my friends. Other founders I know were also lost. Uh, like who am I? And we kind of teamed together and started a fund. And yeah, I guess so. It's a long-winded way of saying I'm always an operator, but sometimes investor.
Tell me a little bit more about Side Door. First off, how did that name come about? And secondly, I do feel like that's going to draw to that first question, but what problem did you feel was out there that needed to be fixed?
Yeah, so I guess the reason we called it side door is like as I was investing, I would meet these founders. Basically what happened was I had a family come to me and ask me to start a fund. I really was like, I'm not a finance guy, but I had made them a lot of money over the years, and everyone thought I would be good at it. I really felt like small funds are return higher multiples and that large funds are hard to return. I think the two things I found true to be about VCs is that less than 5% of them actually return better than market. And then on top of that, everyone holds them up on a pedestal, but to me, they're largely unproven unless they're an established fund with really great sort of process that helps them pick deals, maintain those companies, and exit. Everyone thinks about picking a company, but you still have to grow the company and then sell the company. So I guess holistically, I felt like most large funds have a tough time because they need to deploy so much capital. And so I think that there's a disadvantage to that. They're also often focused on brand because at that point they're probably leading deals, and so it becomes more of a branding effort as well as just being in the right place. So I felt like there was room to have lots of funds at the same time, and that if it were in my best interest, if I was the one investing, I would have lots of different funds that were all between 10 and 30 million each, and then focus on sort of you know uh, the the sort of alpha or asymmetric value that comes from being risk on early in these companies. And so that's what we did. We started a bunch of different funds with different focuses. We have a fund with the state of Michigan, which focuses on Michigan founders. We have a pre-seed seed fund, which is agnostic. We have a late stage fund. We have a digital asset fund. We have a Y Combinator accelerator alumni fund. We have a fund now with junior achievement in Europe. So we have all these different fund products, each with their own thesis, each with their own investment committee, each with their own sort of pipelines and process. And we built it that way. We said, let's not do one fund at the start, like let's do five. And if we're good at playing baseball, we keep playing baseball. So I think the other mistake most fund managers make is they try to grow the fund AUM up. So they go from like 10 million to 30 to then they go 100. By the time you're doing 100, 200 million, it's a very different muscle habit, a different process, a different entire vehicle than if you're doing 10 to 20. So we said if we're really good at what we do, we'll just keep rinsing and repeating what we do and then add a different fund. So we specialize in lots of smaller funds that collectively have the AUM to operate like a large fund. But each individual fund is sort of on its own small, but with all the back office support of a larger fund. So we have 14 funds today, a few hundred investments, and we've been largely successful.
Interesting. Now, you touched upon the Michigan Fund as well. You recently launched the Michigan Fund with a gentleman called Edward Kim, securing up to almost $10 million from the Michigan Strategic Fund. Is that correct?
Yeah, so the
Yeah.
state, the MADC in the state gave us, they backed half the fund. It was a targeted $20 million fund. So yeah.
So, what drove the origin of that specific strategy to look away from the coast and focus on Midwestern industrial convergence?
I think it was less around looking away from the coast and more around the thought process of having a regional fund. I think I've seen some regional funds work really well. Most recently, Vancouver's Founders Fund, which became Rhino. Um, I think when you focus on a region, you can find the best companies in that region, but then the companies to build a true anchor company, and I define that by 1,000+ people in that company locally at the headquarters. So to build a true anchor company, I feel like it needs to have the talent pool associated with being able to sort of sustain that company in that market. And so when I was looking at different markets, it could have very well looked differently. Like if I was looking at Tennessee, which was one of our considerations, I would have looked at like logistics, manufacturing, healthcare. If I was looking in Pennsylvania, I would look at sort of data centers, advanced compute, and probably some mining or extract. Um, what led me really heavily towards Michigan was a number of confluence things. So one, Ed Kim was a good friend and had been in the market running sort of an endowment fund or some small fund for the one of the universities. We felt like there was already an existing antiquated industry and sort of talent pool for manufacturing, advanced compute, advanced materials, and mobility in the state. And the other thing is like no one realizes it's kind of a sleeper, but Michigan has the third largest number of venture deals in the country outside of California and New York. So you look at these things combined and you say, okay, there's this regional effort, there's a lot of late stage money for Series B plus companies, and a lot of these like small investors, like 25 or 50K for early stage, but nothing really in between, which means a company that can't really like plot their trajectory for like escape velocity, they end up having to do like either become a services business to be cash flow positive or think small and sort of just move things over. So I feel like we felt like there was room to come in early at the pre-seed seed to really own that market, to lead rounds with $1 million to $2 million, and to sort of like say, this is where you need to go. This is what the big funds are looking for, and then walk them in on a roadshow to these funds. Now, you'll never be able to do that 60 times. I think a traditional portfolio in San Francisco or LA would work where you would have 50 to 70 portfolio companies. In a market like that, we really felt like there was 3 to 4 good deals a year. So we tried to extend the number of years we were deploying, and then also just really concentrate on what we think the best deals are and just trust that we'll win those deals because we're leading those rounds. And so that's kind of been our approach. And we felt Michigan offered the talent that was needed, the corporate environment for us to sort of onboard large customers or pilots quickly. It offered the entrenched industries that were antiquated that we could adopt or sort of digitally transform. And we felt like it was an underserved market where we could win. So all of those things together led Michigan to being sort of the top of our list for creating a fund for that strategy.
Okay, interesting. I'm going to ask you, as an entrepreneur, and you've got, appear to be a person who wears multiple hats. What did you have to figure out the hard way when scaling Side Door Ventures from its founding into a multi-fund firm managing over 150 investments?
Like, what was the hardest part?
Yeah, in terms of scaling, since the inception, since the idea till the present time, how would you
The
say?
easy part was fundraising because at the time we had all the large LPs. We started really with only like 12 LPs. So that was actually probably we had an advantage there in terms of the easy part. Um, the hardest part was finding a well-rounded team and treating them like partners. So we went to a bunch of founders. We have 23 exits now across the team as founders. So we've really focused heavily on sort of like finding the right founder fit that could help our like fill gaps. So we have guys with healthcare exits. We have a guy with like two robots on Mars and one on the moon. We have people in sort of the fintech space, prop tech space. So we sort of went and accrued a bunch of subject matter experts who were former operators and convinced them to come join our fund. And I think that was assembling the team was like probably the most critical part, but the part we spent a lot of time on in the beginning. I would say as we've grown up, fundraising has become a challenge. So as the market shifted and we have just massive amounts of money from the LPs we already have, as we've expanded and offered new fund products, I think fundraising's become more difficult because people don't know us as well. We really had like this unfair advantage in the beginning where those particular families or family offices knew us really well and just gave us money because of trust. I think as we expanded, even if our IRR is really strong, we're definitely in the top percentile of funds. I think that nothing really matters till you have DPI and you're paying it back. So I think the hard part for us is we have a lot of clear winners that are unicorns, but like, do you exit those positions early as a secondary and sort of pay LPs money back? At the sort of downside of them not really like benefiting from the largest markups they would get, or do you just like hold tight and ride through it because the win will far outweigh whatever you would have gained? So as an example, we have a company we invested in at like 15 million pre. It's probably worth between 4 and 5 billion in the secondaries right now. We could sell it for a lot and pay back the fund with a multiple, but we think there's a really strong trajectory of that company being worth at least 30 billion plus. And so do you just wait 2 years or 3 years and then return that back? I mean, the multiples on that money are quite large and substantial. So there's a lot of this sort of friction around how we exit and where we exit, and less concern these days around if we will be successful. It's just a matter of like how much.
Hmm, understood. Understood. So, as Side Door Ventures aggressively scales its portfolio into deep tech like aerospace, you mentioned, and orbital manufacturing with companies like K2 Space, what operational assumptions did you have to unlearn about capital?
I think we just always did the things. We were always contrarian, so we went after markets that no one was looking at. I mean, it's easy to say space was a win now. Like 5 years ago, I think people laughed at us when we were writing checks in these areas because there's one vendor. It's like the government, and people didn't. It was largely unproven, and there's a million reasons why you wouldn't invest in defense tech or space tech or robotics. I think we did a lot of that. Um, we've kind of been ahead of a lot of things as we've gone. Same with like space and defense tech. I'd say that lately we've been really involved in investing in biotech and medical stuff. And I think a lot of people are still steering clear of that because I think it's foreign to them. And I think we've sort of leaned into those areas. So I typically think that we are a few years ahead of the curve in terms of where we think it's going and where our thesis is driving. But we are unafraid of the frontier technologies, and I think a lot of the VCs, especially in the 2019 to 2022 era, were really focused on just paper gains and investing in a lot of SaaS companies and fintech companies, and we're seeing a lot of those sort of erode, both in terms of competition, market share, maturity of those companies, but also like agentic AI and how much it's impacting all of those potential customers. Um, I think we've largely won on a thesis level, which has also helped us win on sort of the performative, statistics level.
Mhm. Okay. I want to touch a little bit about BTAP, for which you're the co-CEO, and it's a trust and safety infrastructure aimed at preventing systemic fraud in the digital economy. Now, I find it really interesting from financial services angle as well, because that sort of fraud, in a way, financial services firms are also trying to tackle, where it be in transactions, payments, but KYCs. And I feel like you have a similar methodology behind that. Could you tell me a little bit more about BTAB, what it does, and what exactly are you trying to achieve?
Yeah, so BTAP, we're the leader in fraud detection for music. And generally, what we're looking for the most, we have obviously, as you pointed out, different services. So we have KYC AML for different vendors. Especially in music, there's a what we call a principal agent problem where the person collecting often isn't the person that's a beneficiary. So understanding how all the network nodes work together is critical. And I think that's where behavioral analysis really helped. We really started as an auditing product to say how many times is a song played, because there's just a CSV that says, artist A 100 million. Once we started building sort of the source of truth of how many times a song is actually, so you would expect that they would just have this number, but there's lots of reasons why that number is wrong. And then at the same time, it's just an Excel spreadsheet with a number in the cell. So there's no like receipts or evidence. So once we built the auditing technology, we actually discovered streaming fraud and manipulation. And what's happening is a bunch of bad actors, mostly financially motivated, will load songs onto streaming services. They'll play every song like 2,000 times. And no one notices a song that only has a couple thousand streams. But collectively, over like 10 million songs, they can generate hundreds of millions of dollars in revenue, which is theft from other artists. So there's around 4 billion a year that's stolen from artists. And we're the standard for the industry for preventing that. So we sort of found that by accident by building an audit product and then ended up owning that entire space.
For people who don't really understand how this process works, who's the collector and how the money is, could you explain a little bit about how that works and how you're, you know, protecting the artists, protecting their wages, their
Yeah.
earned income as well?
Yeah, every artist made 23% more money because of us last year, whether they know it or not. And so what happens is if you're a streaming service, and I'll just use round numbers and we'll keep it simple. If you're a streaming service and you make $100 million for this month, the month of April, and it's from subscription fees and revenue from ads. So all that money comes into one pool. I'm just going to keep it simple. So let's say we make $100 million as a streaming service. We typically pay all of that money out at the end of the month to artists based on the number of streams they have. So if you're an artist and you did 100 streams and the whole platform did 1,000, you get 10% of the pool, which means you get $10 million. If you're an artist and you did 500 streams out of 1,000, you get 5% of the pool. So you get $5 million. What fraudsters realize is that because number of subscribers is changing, because the number of streams is changing every month, and because the revenue is changing every month, you could release a song that does 1 million streams in November and make $3,000. And you could release a song that does 1 million streams in February that gets paid $1,500, and both could be entirely correct. It's not a flat rate per stream payout. It's a performance of the whole, and whatever they made, you get. And so what fraudsters started doing was loading all of these tracks on streaming services and then playing each song 2,000 times, because no one notices a song that gets paid out $2. Like it's largely irrelevant to them. So you do a lot of these and you create all of these different entities. So imagine I create 40 shell companies around the world and I load it with millions and millions of songs on. And also everyone thinks Spotify or Apple, but there's 100 stores globally. There's Boomplay, Deezer, iHeart, Audio Mac, Amazon, Spotify, YouTube, Apple, like there's 100. So if you only pick the top 20 and you load 10 million songs up, then you generate 2,000 streams per song. You can effectively earn on average, 100 to $200 million a year from this type of theft that otherwise, because of the way it's pooled, would have been paid to real artists. So imagine you're an artist and you did 100 of those 1,000 streams and you get $10 million. But imagine you find out 500 of those streams were fake. So you actually did 100 million of 500. Sorry, 100 of 500. So now you get $20 million, not 10. So the impact on what you get paid is drastically moved once you remove out all the fake streams because your denominator of how it's divided goes down. And so we have slowly started moving all of those fake streams out of the calculations, which means every artist gets paid more money. So they might not see it because they don't get a statement that says, this is what you should have been paid and this is what we paid you. We are in the background for all these streaming services telling them these don't get paid and this is who needs to be paid, and then rerunning the calculations with all the artists. So whether they know it or not, every artist made more money last year because of us.
That's super interesting. And the technology behind it, the thinking behind it, how you came on to, you mentioned it was more of, you started off as an audit service, but kind of turned into a systemic fraud prevention. But does that specific tech mode of differentiating human artistry from adversarial AI noise, does that inform you how you evaluate AI startups at Sidedoor?
Uh, no, I mean, maybe a little bit. I think there's so many different ways AI can be applied. I think it's more around like what proprietary data do they have, what's differentiated. I think a lot of people are confusing initial market traction from blue ocean space to like an actual like infrastructure or proprietary tool that has long-term sustainability. So I think what we focus on a lot is whether or not they have proprietary data, that their training or insights are unique. Like in our case with BTAB, we're quite possibly the only company with that data set in the world, and nothing's ever been trained on them for any of these LLMs. So there just isn't, like, you couldn't just come out of the box with an LLM and be successful at this in current format, which is obviously a defensible proprietary thing for us. So I think there's a lot of insight to like what it means to be proprietary and like how these things roll out. But I think I wouldn't say that directly influences our, like, I think our views on AI were already baked on the side door side, but I think that, you know, I think people are hot to just invest in things that are AI related, and maybe we're a little more hesitant than others.
Okay. Now, with AI lowering the barrier to entry for standard software, pivoted toward backing atoms over bytes, where do you see AI helping or scaring people in your space?
For MySpace being BTAP or MySpace being Sidedoor?
Sidedoor.
Yeah. I mean, I think it helps a lot on fund process. Like we use it a lot. We've used it for years now. When it comes to like creating our investment committee pitches and decks, to sort of like summarizing discussions and putting them into tickets for helping us write emails that are both rejection and follow-up emails to partners after they've sent us a deal. There's a lot of agentic workflows that we've built that help just sort of operate the fund as a whole. And I think that that's all been really helpful and made a smaller fund to be able to operate at a level that most people weren't expecting. I also think because we were all operators and tech people, we were really able to build this stuff ahead of our peers. So we've helped a lot of really big funds with their fund ops and how they build workflows and sort of like how they operate on the back end, because we effectively built a Ferrari from the beginning when we needed like a scooter, expecting that we would have scale one day, and that's what we wanted to do. So I think that I think we've been fortunate that we've been ahead of it. I think we've constantly reinvested in the development of that, and that's helped us sort of like scale quickly, but also sustain that scale. And I think other firms are now catching up, but we've been ahead of that game for quite a long time.
Mhm. Now, I want to ask you about your role in all of this. Now, obviously, we discussed BTAP, Side Door Ventures. Uh, Just before the call, we discovered that you have also been involved in combat fights, and you're doing karate on a professional level. You've also topped the charts, which is a dream for many. Walk me through your typical week managing all of this with all these responsibilities, managing your different ventures. Where does your time actually go?
Well, I mean, I think the reality is my ADHD brain's going to jump into anything regardless. So even if it wasn't BTAP, my brain's going to start researching how to become a lord in Sealand, or like, like what types of random properties are for sale in Argentina or Nimbia. Like, I don't know the like my brain is going to skip regardless. So it's for me personally. Now I don't recommend this for everybody. I think in particular, I was diagnosed later with ADHD, and I've spoken about it a lot, but I think I actually do a worse job if I only have one thing, because I will procrastinate to do that one thing until it's absolutely necessary, until I force myself into a hyper like flow state. Whereas if I have a bunch of things around me and all of these pressures for delivering on those things, my brain is going to keep jumping into those tracks. And as long as I'm passionate about those things that I've surrounded myself with, then I actually am way more productive in the chaos than I am in the quiet. So for me personally, my productivity looks way different than like somebody else's on my team. And I think that that's been understanding that and sort of like building the architecture around my life in that format has really helped me succeed a lot, because my brain's going to do it anyway. And if I don't put formalized things around me for it to do, it's just going to waste all of that effort and productivity on a bunch of stuff that's meaningless. And at least in this case, it's just pushing each little thing further. So I would say sometimes I'm just in a hyperflow state and I text my assistant and say, cancel everything. Like, like I quickly Slack, like just cancel it all. Like I need, like I'm in it, like I'm not moving. I don't want to be distracted. And sometimes I really, really struggle. I could build myself 4 hours of downtime and get nothing done, as like a catch up period. And it's like, I really need to just like feel my body and then just go with the things that it's jumping to. So I know that's like a really a roundabout answer, but the answer is like there isn't a structure because my brain doesn't allow for it. And when I jump into these things and I get into a flow state, then I remove all the distractions I can to just focus on doing that thing because I'm like hyper focused on it. And I tend to get really good at things quickly, answer questions or connect dots really quick.
Mhm.
And in a lot of ways, it's been my superpower for success over the years.
And has it always been that case, or was it a point in time where you realized this is your coping mechanism?
Well, I didn't realize it probably till 4 years ago. That's what I did. But I would say that architecture around my life really formed probably around 2015, 14, 15, when I realized that like I was going to do these things anyway. So I might as well just like put them around me. Uh, yeah. So that's kind of the short answer. And then when I was diagnosed, it just made a lot more sense. Yeah.
Perfect. Now, tell me a little bit about 2026. Where do you think, promises are? Where do you think, in your experience so far, generally people should be more aware of when it comes to capital deployment, investments? What sort of outlook do you have for this year in terms of the industries and kind of
Well, I
investments?
don't really think in year cycles. I think in 5 to 10 year cycles typically.
Mhm.
So I would say that my focus right now has been heavily on sort of the sciences. So uh, a lot of biotech.
Mhm.
I still believe a lot of space tech. So I'd say we're still investing heavily in space. Some defense technologies we're definitely investing into. I think there's some interesting plays with defense tech, especially in regions that aren't the U.S. So really focusing on defense for Commonwealth countries, stuff like that. So we are actively looking, I would say, in categories like that, but we aren't like defined or exclusively to one. If we see a really good deal on something else, we're still opportunistic in that format. So I would say that that's like a the hard sciences. It boils down to like if it's frontier technology and most people are scared because they don't understand it, we're probably the ones going through the door
Hmm.
investigating it. So we tend to go where people aren't.
Okay. And now, when you talk about these deep tech startups, and I'm going to talk a little bit about AI and the AI revolution here. Where like where in businesses do things still live in people's head or in spreadsheets? And I'm trying. So we see a lot of new tech being released to the public almost every week, every other day as well. And the interesting part of this revolution is that the white collar jobs are the first ones to be affected, and the big tech companies, Meta, Oracle, Amazon, they're the ones who are laying off people mainly on this pretext. But when in this current day and age, when you're evaluating the highly technical modes of your startups, where in the business do you think things still are a bit manual, repetitive, or and there is need for improvement and adaptability?
Oh, I find that in every industry. I
Yeah.
think manufacturing for sure.
Mhm.
I think there's a lot of improvements to be made there. Supply chain logistics or procurement. In health, there's a lot of opportunity, especially in AI with healthcare. Like what types of clinical trials can be predicted, or what types of drug combinations or protein combinations can be used. Um, so using AI to sort of like mass run experiments is helpful, or at least helpful directionally to sort of like cementing or you know, ordering which experiments you want to start with first and sort of and prioritizing them. So I would say that there's a lot of gains to be had in a lot of industries. I think we're going to see it across the board. I think the first ones you'll see will probably be SMBs. Like SMBs don't know what they're doing. There's going to be this giant push to sort of use agentic workflows, but really most of them are just going to be doing stuff on Claude.
Mhm.
They're going to need someone to actually like, how do you remove a person, or how do you like do all of this automated? I think a lot of them still don't know that. So I think
Mhm.
there's going to be this like quick rush for AI. Then there's going to be a period where they learn to figure it out as like an operational infrastructure component. And then
Mhm.
I think you'll start seeing that seep into the really large enterprises that have been slow to adapt. And I think that's a huge opportunity for companies that adapt fast. Because if you're fourth in your marketplace or third in your marketplace, or eighth or 15th, it's an opportunity for you to outperform everybody else and maybe get to second or first. And I think it's going to be the ones that are first or second that are going to be the most hesitant to adopt, because it's when you're at the top, it's often easy to sort of like defend as opposed to proactively, um, be
Yeah.
offensive. And I think that that's going to, I think it's going to hurt them, a lot of industry incumbents.
And does it happen so often, when you're talking about deep tech startups like biotech or aerospace, and when they come up with their pitches and you're evaluating their plans and they're evaluating their businesses, but you find out they're, like you mentioned, the operational infrastructure that's not yet, you know, uh, that's not yet ready for AI deployment, or they're not using AI that much to eliminate manual tasks or repetitive tasks. Does that happen quite often, and does that rank highly in terms of your evaluation?
Well, I think in the beginning phases of a company when we're investing, keep in mind we're often someone's first check. They have an idea, but nothing's repeatable or scalable yet because they haven't figured it out. So I think where AI or agentic workflows probably work right now the best are all these repetitive tasks, as you pointed out, or things. I think there's a novelty in what they're creating often that hasn't been created before. So they might use AI for ideas or for making their power superpowers.
Mhm.
But I don't know if I really look for them to use exclusively AI or remove things or whatever. So I think in in that context, I'm less critical on whether they're using AI or not. I think it's more about um, the team. Like we're mostly looking at is this person an expert in this field? do we believe that the other smart people in this field are going to follow that person? Especially in space, I think like the number one driver is whether or not the team can recruit other great members, because really smart people follow smart people. So if you end up sort of like finding a vein of a bunch of people leaving to go start something, we're probably more likely to invest in that than we are to somebody who like is using AI to solve a similar problem but doesn't have the team. Like we're definitely going to follow the team in these harder sciences where there's less brain trust around to sort of replicate.
Okay. Um, Finally, I know we touched a little bit about it as well, and I want to mention the fact that you hold over 40 patents globally, spanning AI, machine learning, blockchain. Looking out at the next 5 years, where's the most defensible, high value IP, intellectual property being generated? Where do you see that?
Um, I mean, to me, it's the same places that we're investing. So,
Hmm.
biotech, space, defense. I don't think it's SaaS.
Yeah.
I don't think
Yeah.
it's fintech. I think it's the harder side, robotics.
Hmm.
There's a lot of really great um, medical advancements around surgeries and identifying types of diseases and curing or drug delivery systems for specific types of diseases. I think there's a huge market around sort of like amino acids and different types of GLPs. And so I just think there's a lot of these types of technologies that are poised to sort of win. So not one, but a lot.
Yeah. Well, Andrew, thank you so much for your time. It's been an absolute pleasure for me to host you. Your trajectory in your career and the achievements, it's masterclass in anticipating financial future. I really appreciate your time, and it was a privilege to have you over here. And I hope you had a good time discussing a bit about your journey as well as being on our podcast.
Thanks for having me on the podcast. Appreciate it.
Thank you.